Monday morning, good morning. I'm Guy Johnson. Lizzy Burden's here. We're an hour away from the opening trade. So what do you need to know? A historic moment in Japan as the LDP loses control of Parliament's upper house. Prime Minister Ishiba says he won't quit, but the results looks likely to further complicate trade talks with the United States. Speaking of trade, EU officials look set to meet early this week as the bloc prepares for a no-deal scenario with Washington. And we're going to be talking to the CEOs of Deutsche Bank and Siemens this hour to get their take on that trade story. And also, we're going to be talking about their plans to invest billions of euros in Germany, Lizzy.
Welcome to a new week, everybody. Happy morning, Monday morning, Guy. And we are getting deeper and deeper into earnings season. We've got that ECB meeting on deck on Thursday, and we're inching closer to that August 1st tariff deadline. As things stand, we had European stocks declining on Friday, pointing even lower this morning. US stocks actually still set to hover around these record highs, but what you really want to see is the market reaction to that Japanese election. You've got the yen at 148 per dollar. It's recovered somewhat, pairing some of the earlier gains. This volatility, though, not doing any favours for an already weakened Prime Minister Ishida. The countdown to the opening trade starts right now.
So Monday morning, what I really want to talk about is how good Scotty Scheffler was this weekend up in Northern Ireland. Absolutely sensational performance. What we're really here to talk about this morning is trade. And trade is the narrative throughout so many of the stories that we're going to be focusing on across the next couple of hours, Lizzy. And I don't know whether to start with Japan, I don't know whether to start with what's happening with the ECB, or whether or not we should just start with the fact that the EU is increasingly getting ready for the idea that it's not going to get a deal with Washington, that Maroš Šefčovič has not been able to pull a rabbit out of a hat, and that we are likely to see tariffs being imposed. And therefore, we're going to see a fairly big response. It is possible we're going to see envoys meeting early this week, possibly with Germany's blessing, to back that move, and we may be about to move into the next phase of this trade war.
Yeah, they're preparing for a no-deal scenario, which reminds you of Brexit, which reminds you of the rolling risk that we saw back in the Brexit days. But look, what are they going to do in a no-deal scenario? One option would be a retaliation of this ACI, the anti-coercion instrument. You wasn't sure whether that would actually hasten a deal before August the 1st. And it just speaks to the divisions internally within the EU, because you've got some member states like France wanting to use that, others saying not. Likewise, you've got some member states saying we can accept higher tariffs if we can get exemptions. Others not so happy with that. But the problem with that
is increasingly it looks like those exemptions aren't going to be there. It looks like the car sector is not going to get the carve-out that people were hoping for. The pharmaceutical sector is not going to get the carve-out people were hoping for. And increasingly it looks like Germany is going to be moving more in line with the French position. It's going to be really interesting. A little bit later on, we're going to hear from two of the biggest CEOs out of that country. We'll get their take. But it does feel as if Germany is increasingly acquiescing to the idea that Europe is going to have to take a firm stance.
Yeah, and also there was this idea of the 30% tariff, the threat from Donald Trump. I wondered at the time whether that was just choreography. It seemed like everyone was kind of batting that away as the sort of thing that you would expect from Donald Trump in the run-up to the August 1st deadline. Now it looks like maybe that threat has made a deal even further away.
So what I can't figure out this morning is whether or not the anti-coercion tool being talked about is a realistic threat. How seriously should we take that threat? How seriously are the United States going to take that threat? The fact that US newspapers are starting to talk about it as well, I think is quite interesting. It's definitely more on the table than it has been previously, and it feels like a more credible threat than it has done previously. The US the US, I think, are increasingly aware, or judging by the media coverage, of what the Europeans could do and how brutal the effects could be.
Now, similarly, of course, you say that trade is the thing that underpins every topic on the agenda this morning. If we turn to the Japanese elections, the fact that you've got Prime Minister Ishida weakened again, having already lost the lower house. Now he's lost the majority in the upper house. How much does this weaken Japan's negotiating hand in trade talks with the US? It seems like Bessent has smelt weakness. The US Treasury Secretary Scott Bessent over in Tokyo on Wednesday, notably absent from the G20 meeting in order to try and get this deal over the line. He says that they could get a good deal, but it could take some time. Has he smelt blood?
Well, maybe, potentially. But I think in its most simplistic terms, this is just going to make it more complicated to get a deal. it's going to take longer, to your point. It's going to take a while to get this done. It's going to take a while to figure out what the political narrative is going to look like. It could also lead to higher spending. The populist parties are beginning to move forward in Japan. Is that going to create higher spending? Clearly, the populace is annoyed at the idea that actually the cost of living is going up. The rice story has obviously been one that's been making the headlines over the last few months. So what is the effect of all of this, I think, is going to be really interesting. And does Japan need to take a moment before it moves forward with any kind of a trade deal to understand the implications of what that could mean? It just feels like everything is moving in the direction of higher tariffs this morning, not lower tariffs. And the Japan story is there as well. I think it also speaks to the idea that you are potentially going to see higher government spending, that this kind of idea of fiscal dominance, and we're seeing it in Europe as well, spending more money. Again, how does the bond market react to all of this? What is the narrative that's going to be there for the Japanese bond market? Are we going to be able to see, actually, the BOJ raising rates in this kind of environment? I don't know, but it's more uncertainty in a world that's becoming increasingly hard to navigate. Yes, in some ways you could argue you buy the yen. In some ways this result is not as bad as it could have been, but the uncertainty encourages you, a bit like the dollar used to do. You buy the yen if there's more uncertainty. It feels counterintuitive, but that does seem to be what the market is maybe doing this morning.
Yeah, and is the Bank of Japan going to be able to raise rates when the lack of progress on trade talks is going to hold back growth, potentially? But you turn us to the central bank story. Let me just run you through what we've got on the docket for the week ahead. We've got, on Monday today, the German Investment Alliance Summit. As you mentioned, we've got those key interviews with CEOs on the ground there. Then tomorrow we've got US home sales data. On Wednesday we have the German Chancellor Friedrich Merz and the French President Emmanuel Macron meeting in Berlin. And then on Thursday, global PMIs, EU and Chinese leaders meeting in Beijing, and the ECB decision as well. And then finally on Friday, UK retail sales data. But I want to focus in on what's happening on Frankfurt, or not happening in Frankfurt on Thursday. We're not expecting a move here because, and it all comes back to the theme of the day, trade and the tariff uncertainty. It looks like this will be a hold, but the question is, will it be a pause or will it be the end to cuts? And really that comes back to...
The expectation is still we get one more cut by the end of the year, isn't it?
Yes, if you look at the survey of economists that we spoke to, a quarter we asked say that the ECB is done with cuts. So the majority think that there is going to be one more, yes.
So it'd be interesting to see if the guard is slightly dovish, so and hinting at the potential for more cuts, how does the euro respond to that? The euro's obviously had a fairly good run recently. That's been slightly tempered by what the dollar's done over the last couple of weeks. But could that story turn around on the euro because there's an interesting MLive story on this morning on the Bloomberg, talking about the fact that the rate differentials could start to matter again, and the gap between the United States and Europe is starting to look pretty big at the moment.
But arguably she's got to be a little bit dovish, because otherwise it's going to look like the end to cuts, and then we'd be talking about a communications failure from Lagarde. It's that 120 level on euro dollar that ECB Vice President Luis de Guindos has said is the danger zone. If you go higher than that, then you've got trouble for the euro area. But don't forget, it's not just a trade story. You've also got the public spending risks to core inflation. So it's that balance of tariffs and spending, as ever, when it comes to the dilemma for the ECB.
I think it's also the EU-China meeting, I think, is also going to... that's going to be fascinating to watch, because the EU is having to battle on both fronts. Yeah,
because you want the US-EU deal, but you also don't want China dumping the euro area with goods, dumping in quote marks, but, you know, that is adding to the inflationary narrative, possibly, and then creating more headaches, or not, for the ECB.
OK, lots of things to think about. Are we going to get a steeper curve as a result of all of this? We're going to find out. We're going to be talking to Marie-Anne Allier, a Carmignac fixed income specialist, joining us a little bit later. Nanette Heschler-Fay, Deir, Lombard ODA EMEA CIO, Ludovic Subran, Allianz CIO, is going to be joining us. And we are going to head over to Berlin. Oliver Crook's going to be interviewing both Christian Sewing, Deutsche Bank's CEO, and Roland Busch, Siemens' CEO, a little later this hour. Looking forward to hearing about their take on all of these stories.
Yeah, you've got dozens of German companies looking to invest hundreds of billions of euros into Germany. And this is a key meeting between the Chancellor, the Finance Minister, and all of these business heads. So really looking forward to Ollie's interviews there. Here's what else you need to know this morning. Israel has warned that it will move for the first time into a town in the heart of the Gaza Strip that it had earlier skirted for fear of harming hostages. The military on Sunday told Palestinians in Deir Al-Balah to evacuate southwards. Officials in Gaza say that a total of almost 1,000 Palestinians have now been killed while waiting for aid, including 67 yesterday. Witnesses said that Israeli tanks fired shells towards Palestinians awaiting the entry of food trucks in northern Gaza, an area that has seen intense clashes with Hamas holdouts. Elsewhere, the Washington Post is reporting that a Chinese-American employee of the US Commerce Department has been barred from leaving China since April. According to the South China Morning Post, he travelled there to visit family but was detained when he arrived in the city of Chengdu. The Washington Post cites sources saying that the man is being held because his case is linked to actions Beijing considered harmful to national security. And finally, the US Federal Aviation Administration has cancelled the temporary ground stop on Alaska Air. The fifth largest US airline earlier sought a temporary grounding of all planes for its main brand and Horizon's air unit after suffering an IT outage. It's the second time in just over a year that Alaska Air has had to ground its fleet because of IT problems.
Talking of airlines, RyanAir net income more than doubling in the first quarter. The carrier seeing a strong summer as well. We'll check in on its shares at the open. The CFO was joining us a little bit earlier on. We'll hear from him. Plus, the earnings season ramps up on both sides of the Atlantic. It's a huge week this week. In Europe, big banks and luxury names are amongst the key prints that we're going to be watching. But up next, we're going to be talking about what is happening in the bond market. Traders very much having their eyes on what will happen at the ECB this week. But our next guest believes that we are heading for steeper curves. Marie-Anne Allier will be joining us after the break. You got any questions for Lizzy and me? You want to join in on the conversations that we're having? IB Plus, BBTV Go is the function that you want to be using on your Bloomberg. Looking forward to hearing from you. This is Bloomberg. Welcome back. Monday morning. I'm just reading through the statement that's coming through from Stellantis, which has just dropped over the last couple of minutes. The giant car maker based out of the United States and out of Europe. Remember that this is a company that suspended guidance not that long ago, I think back in April, and as a result of which, what they're now trying to do with a preliminary release this morning is maybe to try and address a gap that they clearly feel has opened up between analyst expectations and what the business is seeing. Now, I think one of the key things to take away from this is that the company is taking approximately a 3.3 billion euro charge, net pre-tax charge. This is primarily related to program cancellation costs and platform impairments. This is a substantial charge and is going to have an impact in terms of analysts' expectations. The market had anticipated, let me just go back to the pages that I need, the market had anticipated that we were going to be seeing a profit in the first half of 25 million euros. It now looks like the company is going to be posting a first half net loss of 2.3 billion euros as a result of some of these charges, Lizzy. So we'll see how the market reacts to that one shortly. But it looks like a significant gap maybe has opened up between market expectations and where the business currently feels it is. And it now clearly sees a need to address that.
Yeah, we'll certainly keep an eye on Stellantis at the European Open. We'd have liked to see the results of the Japanese election in the Japanese markets this morning. But, of course, it is Marine Day, a holiday for Japanese stocks and bonds. We had, of course, the Prime Minister in Japan, Shigeru Ishiba, insisting that he's going to stay on, despite the ruling coalition losing its majority in the upper house. But what we can look at is the yen reaction. So for that and more, let's bring in Bloomberg's Valerie Teitel. Val.
Yen is gaining as we speak, now strengthening nearly 0.5%. There could be two thinkings after these results. Is one, maybe the market expected something a lot worse, and perhaps the market is maybe relieved to hear that yet again we're hearing the Prime Minister vow this morning to stay on as Prime Minister. There will be some risks headed forward, though. The last three LDP Prime Ministers, when they lost the upper house, did stand down in the 2 months following. So maybe a key risk for the market to keep its eye on whether we get further political instability coming out of Japan. But at the moment, the market seems quite happy. The yen is stronger by 0.5%. The other risk events we have to keep our eye on this week out of Europe is the ECB meeting. The one thing that is starkly different between the June meeting and this meeting in July is this renewed threat of 30% tariffs from the U.S. So with that, guys, we'll be watching for any language on the growth outlook from Lagarde. She previously characterized the risks to growth being tilted to the downside. Does she perhaps amp that language up a bit more, maybe a bit more bearish on European growth with the overhang of tariffs? And also, we'll watch for any explicit guidance on the September rate cut, but they'll probably just leave that open in a vague manner. Lastly, in Europe, we also have EU banks reporting at the tail end of the week. We have Unicredit, and then the big one, Deutsche Bank and BNP Paribas on Thursday. The focus then shifts to the UK with Lloyds and NatWest on Friday. Guy.
Looking forward to all of those bank reports that we're going to be bringing you later on this week. Give us a real idea of what is happening within the European economy, plus also the ECB to be folding into that as well. Let's talk about the fixed income story. How does it relate to all of this? Marie-Anne Allier, fixed income fund manager at Carmignac, joining us this morning. There's a bunch of stories that I think are worth focusing on today. Can we just start with Japan? I just want to get your quick take on what is happening with Japan right now. We've got a fairly historic event taking place with the LDP losing power or losing its majority, yet not a very big market reaction. Why do you think that is?
Well, I think it's first the Ishiba is saying that he will stay on power because of a US and Japan negotiation. But still, we don't know how the rest of the LDP leaders will react to that. It's not a done deal that it could stay. So at the moment, I think the market is still trying to extract some information and how it will go. And remember, the yen weakened quite a lot before the election, as you just said. Maybe the market was expecting for a worse result. They are just short 3 seats, and you have no leaders on the opposition that can, take the power.
Do you think it could impact how the BOJ reacts? Like, clearly, a lot of people are very upset with what is happening with the inflationary story in Japan, and maybe this is why we're seeing the result that we're getting this morning. Do you think it could impede the BOJ's path to raise rates?
Yes, I think it could. The first thing could be, well, even before the election, what we have is quite a lot of inflation in Japan, and the BOJ being late. In another country, maybe it will be a too late weather or something like that. So usually the BOJ should have hike rates more than that, considering the inflation. The fact now is that how fiscal will be on the top of the agenda for the government, how they will help, and how they will force or not the BOJ to hike rates. So I think the market for the moment is looking at the BOJ as too late in the cycle, and it could explain why the long part of the curve is heading so badly.
Marie-Anne, good morning. It's Lizzy here in London. I just wonder, on the fact that, Ishida has kind of lost his grip now on both houses of parliament in Japan, and there's this expectation that there'll be pressure for more fiscal loosening in Tokyo. How do you expect that 40-year JGB auction to go later on this week?
It's very difficult to point one specific auction, in a sense that you could have the BOJ, under the door that trying to buy and to calm down the market. What I think is, on a longer term, if the BOJ don't hike rates, if the BOJ is late, you will probably have bad auction, or at least a rise in the long part of the curve. The next auction, they know that there is, some noise, and could be here to help the market to digest this one.
And when it comes to the curve steepener trade more broadly, Guy was referring to the US picture. I wonder, is it really the curve steepener trade the best defence when the US Treasury is talking about perhaps funding some of its fiscal spending with T-bills? Are we really trying to cap the longer-term yields? Is that really the place to be going?
Again, it's a question of, inflation, interest for the longer part of the curve, because it's not steeper just because people, are selling the 30 years or something like that. It's just because people lose interest in the very long part of the curve as well. You don't have any more issuer, let's say, even the US government is saying that they will reduce the weighting average maturity of their debt. So you have less issuer, less interest in terms of buyers. I am too old to invest in 30 years bonds, and probably my kids are too young to invest in that. And in a sense, it will be something that will be, less liquid, less interest, less impact in real economy. I don't know who has interest apart from some, utilities or infrastructure project to invest and to issue on the 30 year. So you could have, this steepening just because people are no more interested in buying or selling in that area.
How much more could we see the curve steepening, do you think? How far through this process do you think we are, Marianne?
I think we are not at the end of the process. I'm not saying we will see, 100 basis point more steepening in the curve. I'm just saying that it's probably a cheap hedge. It's probably something. It's very consensual. So I know I'm not, bringing in the debate something very new. It's very consensual, but it's not because it's consensual that it is stupid. And again, I think we are at the we are at the middle of the process, and we could have another 40, 50 basis points of steepening between the 2 and the 30s, let's say.
And is that something that's going to be with us for a while? Are these very steep curves going to become the new normal? Is this what we should look forward to for a period of time? Because that's going to have long-term effects, particularly in the United States, in terms of the mortgage market and various other markets that feed off that as well.
Yeah, it's true that it has in the US some impact in 30 years, where I'm not 100% sure that the mortgage is only on 30 years and the 10 to 20 part of the curve is not important as well for mortgages. But let's say, yes, it has a bit of impact. But again, with a central bank that will cut, I don't know if it's tomorrow, in 1 week, in 1 month, 1 quarter, but the next move for the Fed is probably cutting rates. You will have this kind of, when inflation is still, at above target, you will have this kind of a steepening of the curve. And again, it's not just in the US, it's in Europe, in Japan, in UK. You have these fiscal plus inflation fears that are all, going into the curve and the steeper curve.
Marianne, just really briefly, what is driving the 2-year yield moves at the moment? Is it the data? Is it the threats on Chair Powell? Is it the dovish Fed speak from the likes of Chris Waller?
I think it's kind of, all together. The Fed story, yes, it's important, not because of Powell, because everybody knows Powell will leave next year, so it's a done deal, we know that. And if the board is not changed, I doubt that it will change a lot, the story of the next move. But it's tariff, it's Fed, it's political pressure, it's the fact that probably you have a bit of a de-treasurization or de-dollarization in the world. Altogether, it's a weight on the long part of the curve.
Yeah. All right, Marianne Allier, fixed income fund manager over at Carmignac. We thank you. All of it in the mix. To Germany next. This is Bloomberg.
30 minutes to go until the opening trade here in Europe this Monday morning. Let's talk about where the futures picture currently lies. We are obviously watching a big earnings week coming up. We've got the ECB on deck. There's plenty of things to be thinking about. Quiet start, you could therefore argue, to the beginning of the week as we work out exactly which direction we are going to be heading in. Bond market, a similar kind of picture at the moment as well, Lizzy. But again, you've got the ECB, you've got to fold in what is happening in Japan this morning. There's a lot going on.
Yeah, look, we've got yields lower across the curve, across the European continent. We're focused on Germany this morning. The German 10-year yield at 2.649 at the moment. But it looks increasingly like there's not going to be a US-EU trade deal. And we've got Ollie Crook sitting down with a few CEOs who would very much like to see some carve-outs.
Absolutely. Germany's been moving in that direction. Germany's been hoping that it's going to get carve-outs, particularly for the car sector, particularly for the industrial sector. That is looking like it is going to be harder and harder to achieve. So, A, how do you prepare for that? And B, how do you invest in Germany to take advantage of the current government largesse that appears to be emanating from Berlin? There's two people that we should be asking, so let's hand things over to Ollie Crook.
Yeah, that's right, Guy. I mean, we know we've been talking about it for years. The German economy has been effectively flatlining for a number of years. With the new Chancellor, Friedrich Merz, he's made it the central promise to turn that economy around. The first step was by amending the German constitution to change the so-called debt brake, freeing the government to unleash potentially more than €1 trillion in debt financing. Now the question is, how do you spend that money? How do you attract the private money? And critically, what reforms are needed for the structurally within Germany? So it's not just a sugar high, but a meaningful reordering of the economy. Here to help answer those questions are the leaders of two of Germany's most important institutions. We have Siemens with its deep heritage in the German industrial base, now leading the way in bringing the industrial and the digital worlds together. And of course, Deutsche Bank, the biggest lender to Europe's biggest economy, an institution whose capital flows through both the national champions and the countless SMEs that compose the Mittelstand. Christian Zaving, Roland Busch, thank you so much for joining us on Bloomberg today. You're meeting with the Chancellor a little bit later at the behest of, well, really you guys, having founded this initiative of Made in Germany. We now have pledges of upwards of 600 billion euros worth of investment. What do you hope that Made in Germany can deliver?
Well, thanks. First of all, thank you for the invitation. Look, I think we all strive for the same goal, which is to finally have growth and competitiveness back in Germany and in Europe. And I do believe, and we do believe, if growth is coming back to Germany, it's also good for Europe. And in this regard, growth cannot only be debt financed by the government, cannot only be stimulated by the government. Actually, we need the economy. And therefore, a small group around Roland and myself and others, within a couple of months after, in my view, a solid start of the government, actually said we also want to step up. We want to show what potential Germany has. And therefore, we founded this initiative. And I think it's quite impressive what we have collected after a couple of months with over 600 billion of investments, 61 companies. And to be honest, I think more to come over the next months. But it shows what the sentiment is and that we have a chance.
And so I'd like to get an idea sort of more concretely, because we're sort of in the age of large pledges to government and spending in local economies. So I'd like to get an idea from Siemens, for example. How much of that money is coming from Siemens? And specifically, what are you targeting those investments into?
Well, so, I mean, this goes much beyond Siemens. No?
Yeah.
These are more than 631 billion euros, which we are talking about. And it's a combination of, as you said, 61 companies, it's corporations, it's financial institutions, but it's also small and medium-sized enterprises and startups. So it's a combination. They're all geared for deploying capital into a country where we believe in its innovation strength. We have small and medium-sized companies, hidden champions. They are unique in their technology. And we believe that with the people which we have, we can drive this to the next level. Yet, you need a little bit of structural changes in order to really attract the capital. We all know that. They've identified 9 action fields, and they are almost completely in sync what's written in the coalition contract. And in coming to Siemens, I mean, we're investing in manufacturing innovation. In Erlangen, for example, we want to invest in what we call the industrial metaverse kind of manufacturing, driving digitalization to the next level. We are about to deploy that capital as we speak. The same is what happens here in Berlin. It's a completely new precinct in Berlin. We're investing, leveraging also other financial investors' capital. It's a fully digitalized city, living, working, and manufacturing at the same time. Capital will be deployed as we speak, and so on. But we have more than that. We have more than 50 lighthouse projects from all the companies where they say, these are my ideas, this is what I use the capital for.
And so let's sort of zoom out and see, kind of looking into the future 5-10 years from now, Christian, when we're trying to imagine if this initiative is successful and the initiative of the government, what the German economy looks like, how different it might be from the sort of traditional ideas that we have about the German economy, which is a lot of smokestacks, a lot of heavy industry, very energy dependent. What do we look like in this this, what does the economy look like in 5 to 10 years?
Always hard to exactly zoom out and says what it looks like in 5 to 10 years, but you know, sometimes history tells you what is possible. If you think about how the German economy actually changed over the last 30 or 40 years, when I started in banking, in the area or in the location where I started, this was an industry, or this was a location which was dominated by textile and the printing industry. It completely changed. And if I think about family-owned companies, if I think about Siemens, if I think about others, how they now actually apply artificial intelligence for industrial processes, I think Germany can be and must be a technology-led country. If I think about sustainability, technology with regard to sustainability, we haven't talked about sustainability so much over the last 12 months. Well, this is a key topic. Germany has the leading technology to actually master that challenge, to export that. I do believe, by the way, that Germany will always be an export country. And then with leading technologies, we can master that. For that, you need investments. For that, you need to up to date. And therefore, it is so important that we actually invest into our capabilities. Third point could be defense. I'm actually glad that we are upsizing our defense, not only in order to defend our own continent, but moreover that most of the defense investments will actually doing very well for future technologies. So you can actually initiate a new industry with defense investments. So I think we will see a further development of the German industry, but I do believe that technology, artificial intelligence, but also sustainability will be something where German industries will be leading in 5 to 10 years.
And Roland, you are sort of coming from this company that has this heritage in extreme heavy industry. It has now transitioned to do exactly sort of what you're describing there. So how do you appraise the kind of Germany's structural advantages in order to sort of take advantage of what we're talking about here?
So let's take the AI technology as one of those fundamental technologies which are fundamentally changing actually everything. We talk about industrial AI. So what you do need is data. I mean, better data beat better algorithms. So we are sitting on a massive amount of data. This is one of the most industrialized economies in the world. And again, small and medium-sized enterprises, large ones, they're creating data from their buildings, their manufacturing sites, their engineering. So this is number one. And we can leverage that data and bring it into what we call industrial foundation models, which are not hallucinating. They are really working on the shop floor, agents which act on your behalf, doing things on the shop floor, managing actually lines or even whole plants, together with people trained on AI technology. That does not go without people. We need people who use these technologies. And the combination of this innovation strengths, domain know-how, but also the data we have available, that can help us a bit. The only point here is we need less regulation to release the power and the speed with which this technology can really hit the market. So there are a couple of things which we have to change. I'm constantly saying that. But the potential is there. Well,
while we're on the subject, I'll stay with you because this is my next question is the roadmap to getting there, right? We've laid out the ambition, now the roadmap to getting there. Specifically, what have you been encouraged by what you've heard from this government, and what, what reforms concretely would you like to see in the next 6 months?
So we have 9 action fields, and again, they are in sync with what the government is planning to do anyhow. And just to spell out some, number one is coming back to innovations, the way how we are supporting innovation, university, schools, education system. The other one is the labor market. We need the best talents in the market. We need to deploy the working forces which we have. We have to bring people who are coming to us into work. Another one is the investment climate, that you have incentives for investing and deploying money. And we see some first actions already taken by the government. We talk about less regulations, faster decision processes. It doesn't help if it takes 5 years to get an approval for a plant, then you want to deploy capital in the next 3 years. And the other one is digitalization. You have to digitalize the companies, but also government processes, because you can be much, much faster and much more productive in doing so. So just to line out some of those areas, it's not, we know what to do. It's about doing actions.
But Christian, we've heard about cutting red tape in Germany for how many decades now, right? This is something that we keep hearing about from the government. What do you think, again, like concretely, what would you like to see from this government? You speak to, every basically business within Germany. What are the sort of 3 things that you could really concretely put into place in the next 6 months, which would encourage these companies and give them the confidence to invest?
Well, the 3 main complaints of the people, and in particular of family-owned companies, but also larger companies, clearly regulation and bureaucracy and their speed. And this is an issue where it's not only Germany, we also have to have a far bigger influence on what is happening in Europe. And therefore, I also think more leadership, a stronger government in Germany will also help to do structural changes in Europe, which we need. Number 2, energy prices. It's still an issue. Now, I think the government is going into the right direction, but this is something which we clearly need to have in mind. Number 3 is the labor market, flexibility around the labor market. This is kind of the feedback we get from our clients. Now, I think there is a 4th one. As I said, the government had a good start. We need to focus on our pension plans, because I do believe it's not only important that we have a secured system for our people, for the retirement people, also in 10, 15 years' time. I think it's actually the key to success for investments. If we have a capital-based pension plan, that also means that more investments will go into our economy. It's nothing else than the real start of a domestic capital market. That's what we need. If we can focus on that, I think even more foreign investments will run into Germany.
So you've touched a number of points. I want to pick up on a couple of them. But a little bit earlier you said you think that Germany will remain an export economy at a time when we're seeing that sort of concept really being challenged at the global scale by the United States. I'd like to get an idea from you personally, but also the clients you speak to. How are they weighing the optimism that comes with what we're heard from the German government with the risks that we're hearing from the United States? And is it, what is winning in terms of making decisions for businesses?
Well, I think it's all about diversification. I think we learned through COVID already the first steps of what it means to be diversified, not only to diversify your production and supply chains, but also your, so to say, sales market. So I think a lot of companies are actually looking into diversification, more agreements, more bilateral relationships. But I hear nobody actually talking about let's only focus on the German market, because we know that's too small. Second point is actually that we all need to focus more on Europe. We need a stronger European home market. The stronger this market is, with 450 million consumers, the better it is also for our negotiations versus the US, versus other countries. And therefore, I do believe the stronger you make yourself, and again, this initiative is prone to that, the better your starting position is. But I do believe that most of the companies are not trending away from globalization. They are simply saying, how can we diversify and making sure that we are not too dependent from one or the other country.
And Roland, I mean, the rest of the world may not be, but the United States certainly is. We're going to get tariffs from at least 10 to 30% in the next 2 weeks. How are you sort of appraising that risk and how it could sort of affect the plans here within Germany?
So what is the eventual outcome? Let's put it that way. We will end up in higher tariffs vis-a-vis the United States.
Yeah.
What we don't really want, actually we wanted to have lower ones because we believe in free trade. This stimulates economies and growth. So that would drive inflation to some point. However, there's one point which is super relevant, is we have to stop this uncertainty. So once there's a deal, the deal should be the deal. And then we can deploy capital again based on facts, how the tariffs look like. And hopefully that they are not going too high into extremes, because that would harm economies. And secondly, it's super important. If we finally manage to make free trade agreements in a couple of years and not decades, that's super relevant. Because what would you do if you have two large economies which you're depending on? Diversify in other ones. ASEAN is a super important region, growing region. Middle East, we have South America. So there's so many regions where we can create other markets on top. And I'm not saying that United States is not a relevant market for us, and it's still the most relevant market. but still, there are opportunities, and then we are ending up in a much more resilient and better system.
Yeah, and so talking about some of the investments that you, Roland, have made in the United States over the last year or two, basically $15 billion worth of deals in kind of AI-based and digital businesses within the United States. I'd like to get an idea, did you not see those kinds of opportunities within Europe? Is that something that you could see happening with Europe, or are the companies just not there?
No, the investment you're talking about are two investments, a 10 billion investment in Altair, simulation software, 5 billion, also in software for simulating molecules. It's about the pharmaceutical and biochemical market. And I have to say that if you look for software assets, indeed, you will end up in the United States, mainly. There are alternatives. We also invested in European companies, smaller though. But we are not hesitating to invest capital, R&D, but also M&A in Europe. We're looking into companies there as well, hardware companies with domain know-how, hardware which creates data. So, but in that case, if you really look for software, and Siemens invested really quite a bit, 25 billion over the last 14, 15 years in software, most of that comes from the United States.
And we've been talking, Christian, a lot about European champions and changing the way that we think about preserving companies at the national level versus the European level. And I want to understand sort of your, when you look at Deutsche Bank, which is now at the end of what was a very long turnaround process, but now is feeling like it's in a strong and confident position. Is this a moment for Deutsche Bank to get into a much more sort of aggressive mode in terms of expansion mode, potentially looking at M&A across borders? What do you want Deutsche Bank's role to be in the kind of world of European champions?
Well, I do think what we see in this world is with all the geopolitical uncertainties, with all the also economic uncertainties, there is one trend which is the same across the world, that our clients want to have a European alternative to the US banks. We have very strong US banks, very capable US banks. But in this world of geopolitical uncertainties, they want to have a capable global European player. And there are not so many European banks left with a full investment bank, with a full corporate bank, with a global network in over 60 countries. That's the role we can play. Now, this role we not only want to play because we feel ourselves as a global bank, but it's obviously much easier to do that if you are coming from a country which is economically increasing, which is economically on the right path, and which is also pulling now Europe. And therefore, I think we have a unique chance, not only as Germany and Europe, but also as Deutsche Bank, to actually be the one who is facilitating and who is contributing to our clients' growth around the world. The diversification also in banking, not only to rely on one bank, but on many banks, and that from a regional perspective has never been bigger than RAN.
And you touched about diversifying, and just another question to you. Is this buy Europe trend, is this a lasting thing? Is this something that you're seeing from investors that you talk to, that they're wanting to make a meaningful commitment to Europe? And what does that actually look like in terms of numbers from where you're sitting?
Well, for the first time we see, obviously, since the last 3 or 4 months, a quite significant reallocation from funds, in particular into Europe. The interest is huge. Whenever we talk with investors, they really want to understand what's going on in Germany, what's going on in Europe. By the way, already in Davos this year, 6 months ago, most of the investors said, micro, Germany is really good, and with that they mean the German corporates, the German companies. Macro, you need to do improvements. And that's exactly what we want to try now. Of course, the government stepped up with the fiscal program, but also with the reforms. If we now actually do something, so to say, together, if we march in parallel, we have a huge chance. And then I do believe, with further reforms to come, and that is necessary, I do believe that this trend of reallocating funds to Europe will not stop. If we are not doing further reforms and just rely on fiscal debt, that doesn't help. We need the fiscal reforms.
Yeah. And Roland, a sort of final question to you to sort of close things up. You know, Europe does not want to become the United States in a lot of different ways, but we do want here sort of capital markets like the United States. We do want the kind of innovation we have in the United States. From what we've seen from the Trump administration and really the U.S. for the last couple of decades, what do you think Europe can learn and can take from that without sort of sacrificing the parts that are very important to here?
And that's a very good point. We have to hold on our values. They brought us where we are, and they are good, and we keep to these values. We really have to make structural reforms in Germany, but also on European level. That requires courage. It requires solution orientation. but also really bold moves. You cannot just take one of the problems which we have in these acts. You cannot take an act which is substantially misconstructed and fine-tune a little bit. So we have to go back and really think about what is it, how can we accelerate the development, the economic development, but also the innovation development. And again, it's making bold decisions and make them fast.
Well, gentlemen, thank you so much for your time today. Christian Sewing, Roland Busch, and this commitment that we've got for Made in Germany, more than 600 billion euros being pledged from a dozen of different companies across Germany, and we'll be having a meeting there with these gentlemen and the German Chancellor a little later this afternoon. This is Bloomberg.
Welcome back. Monday morning. Lots to think about. The trade narrative absolutely front and centre right now. At the moment, it looks like European stocks are going to open fairly flat. But considering the risks out there, I find that quite surprising in so many ways. It was interesting. We were just hearing from Roland Busch, Christian Sewing, talking about what the narrative is going to be like going forward in Germany. Europe needs bold decisions, and it needs them quickly. We are potentially facing a trade war which could kick off on the 1st of August, 6th of August. I don't know when it's going to happen. But Europe needs to be ready for it. And I'm not entirely sure, listening to that conversation, that we are.
These are some of the key voices who are lobbying for exemptions, who are lobbying for a deal by August 1st. Doesn't at the moment look like we're going to get one, but this is what the market is focused on right now, regardless of the Japanese story.
Roland Busch talking about we need certainty on trade with the United States. That sounds very nice. Feels like that's not what we have right now. Monday morning. Considering all the things that are about to happen, all the potential risks that lie out there, once again, this is a market that is shrugging its shoulders and saying, meh, nothing to see here. Move on. Nothing to really action, nothing to trade on. You can see this is Friday's trade. Look, we trade down a little bit lower in terms of the European narrative. European markets kind of drifting sideways at the back end of the session. US markets drifting sideways for most of the session. Monday morning feels very similar to that. I'll show you what the futures picture looks like. There's some big corporate stories out there. Stellantis is going to be one that we'll talk about in just a second, but there's others out there as well. But this market just feels unfazed by anything. Absolutely anything. The 1st of August is approaching rapidly. How does Europe respond to that? I don't know, but it could be a fairly ferocious fight that we're moving up towards. The Euro Stoxx 50 this morning, absolutely unchanged. FTSE futures, absolutely unchanged. DAX futures, absolutely unchanged. You might not need FTSE futures for much longer. Maybe we're heading towards 24-hour trading. We'll watch that one with the LSE group this morning. But we are unmoved. What is it that shakes this market? I don't know, but this week is littered with events that could potentially provide some sort of a catalyst, Lizzy.
All right, let me try and inject a bit of excitement into all of this. You talk about the corporate story. You mentioned Stellantis. Let's go there first. They've recorded this 2.3 billion euro net loss in the first half when analysts were expecting a profit. So they've tried to get ahead of it and explain it. They're putting it down to restructuring expenses, waning sales, and the impact of tariffs. So we're seeing it showing up a little bit here. We're also, if we stay in transport, having results from RyanAir, a material beat in Q1. The CFO is saying that things are moving in the right direction. Do traders like that at the open? And then a bit of M&A. Carrefour said to be working with Rothschild on a potential sale of its Italian operations. So we look at that as we head towards the open, Guy.
OK, let's get you into that open. Let's figure out what is happening this Monday morning. Do not expect fireworks. Do not expect lightning to strike, because you are expecting a market that is expected to be unmoved. And that is exactly what we are getting. FTSE 100 barely budging. In and out of negative and positive territory. I suspect you're going to see similar stories with other markets around Europe as well this morning. Stock 600. We'll wait to get a little bit more clarity through on what is happening there. But there's the IBEX, barely budging as well. CAC's not expected to do much this morning. DAX could be a little bit more interesting. I think there's a few stock stories out there that could be worth watching. The auto sector certainly will be in focus. Remember, we've got Stellantis, which has just posted the preliminary read this morning. You've got Volkswagen later this week, back end of this week. We're going to be seeing numbers out from the German giants, so we'll look forward to those numbers a little bit later. But look at this. What does it take to move these markets? What is it going to take this week? The earnings story is going to be one that you're really going to want to pay attention to as well. But we're counting down. The drumbeat on trade is getting more and more audible. And you do wonder why by the end of this week whether or not we're going to be focusing on that narrative much, much more. But But first thing Monday morning, Lizzy, there is nothing to see here. Single stocks, maybe the sector story a little bit more interesting.
Well, let's look under the hood, she says, as she turns to Stellantis, down more than 2% on that news that it's recorded a loss in the first half. After the expectation that there would be a profit. So those shares currently struggling. We're waiting for some of the other individual names to open, but Daimler Truck is one of them, up 0.4%. The FT having reported that it's mulling a China production exit because of a crazy down cycle, in their words, that they've been facing. So those shares are actually recovering nicely off the back of that change of direction for them. We wait for Carrefour to open, we wait for RyanAir, but if we look sectorally across Europe, you've got just over half in positive territory. Basic resources leading the gains this morning. Autos and parts at the bottom because of, as I say, this weight from Stellantis. That sector down 0.6%. But some of the other winners this morning, travel and leisure, real estate, media, but none of these moves particularly big in either direction, guys.
So, see, the material stocks are up. There's this Tibet dam story coming out of China that is moving forward. Apparently, it's moved the iron ore trade, which actually maybe is lifting what is happening with with some of the mining stocks. So maybe there's something of a narrative to watch out there. The car sector is not responding a great deal to this news. You would have thought that the scale of the miss coming out of Stellantis, you may have thought you would get a bigger reaction, but that's not what we're getting this morning.
Yeah, but when you say, it's more down to the restructuring expenses, perhaps an individual story rather than the tariff story. Let us not overstate the impact of the tariffs on the business and whether it'll be a continuing theme across the sector. But we could get some more analysis now with Nanette Heschler-Feiderb, who is, of course, EMEA CIO over at Lombard Odier. Really good to have you back, Nanette, on the opening trade. Guys been talking... Oh, well, that's...
We'll assume that's a bad thing.
It is.
We'll come back
to you, Nanette, in just a moment. Guy, you were just talking about how we're waiting for something to happen. Is this a summer lull that we're seeing in these markets? When you look at the US, they're kind of bouncing from record to record, but they're not lifting significantly higher each time. Is it because they're waiting for trade certainty? You've got the prospect of rate cuts in the pipeline, but you've still got this continued threat to Powell. Surely that is going to continue for the rest of his term.
If you'd have come into this market and looked at all the risks that exist and said, are we going to get a market reaction to this? In isolation, you'd be saying, yeah, these are big stories.
Yeah.
But
they can't impress. Nothing
moves the market right now. Nothing seems to provide a reason to generate a downdraft, a significant updraft. There's nothing kind of here that is exciting the market enough to get it moving. And I've just had a 2-week break, and I come back and I'm looking at these markets thinking, how on earth are some of these stories not having a bigger effect than we're seeing right now? Why is volatility being crushed? Why are equity markets doing what they're doing right now? Why is the bond market doing what it's doing right now? I'm struggling to understand why the market is so unmoved. So is it the right reaction? Is actually the data telling us that that's what you should be doing right now? Or are these risks, are we so kind of immune to them? We're punch drunk in terms of kind of where we sit, in terms of kind of how big a hit it would take to actually move things.
Well, let's ask a true expert, Nanette Heschler-Feiderb, EMEA CIO at Lombard Odier. Let's go back to you. Nanette, can you hear me?
Yes, I can. Good morning to you.
Very good. Well, Guy wants to know what's going to lift the lid on these markets. You say that the S&P is treading water at the moment. Is a removal of the tariff uncertainty the answer to get a bit of excitement here, to lift these stocks a little higher?
Well, it could be both ways, really, because the 1st of August could very well see also tariffs come into effect. Right now, the market is behaving a little bit complacent with complacency, just imagining that the 1st of August would perhaps lead to the next tariff pause and so forth. I think the market at the moment is a bit oblivious to the potential that we may be waking up and seeing some of these tariffs come into effect. So I think there's both ways possibility, either a clearance with indeed some deals that have come into effect before the 1st of August under this threat, or the reverse.
Yeah, so let's look at it the other way. Let's say that August the 1st is a cliff edge for stocks. We're looking at the S&P E-minis at 6,349 right now. How fast could that unravel? How fast could that drop to 6,200, 6,000 even?
I mean, look, at these moments when also valuations seem to be high, and we are in the midst of really at the start of the earnings season, and the first batch of earnings has not been bad at all. So it could very well be that we get easily to a 5% sell-off here if there is really major negative surprise. I think the safest assumption is to view the volatility currently, the VIX at 16, as really low. And that would probably then be lifted higher relatively fast. We saw that whenever there were major surprises.
But we're not getting it. And Nanette, good morning. And the list of things out there that could upset this market is long. Yet the right trade every time seems to be to bet on risk. I'm just wondering whether or not how big the shock needs to be to change the market sentiment. The sentiment continues to be maybe more with retail and less with institutional, but the trades continues to be buy dips. Any dip that's out there, you should buy it. Is there anything that changes that in the near term?
I don't. For as long as, Guy, there is no real material probability of recession that would put us on a completely different path, I think you're right. The market is going to be biased towards using the opportunities of setbacks that can be transitory, that can be given really by anything. I mean, when valuations are really lofty, such as they are in certain sectors in the US, it doesn't take much to get a sentiment change here. But what we are going to see is a bias to buy the dip. And also historically, it's been the case that when the market is selling off by 10%, for example, you could blindly come in and benefit from it by taking, again, an entry into the market. So I think that this bias will remain for as long as there is no recession probability that is material for 2025, and that is also our base assumption.
Is this the last set of earnings that are going to be okay, that aren't going to be affected by the tariff narrative? I'm seeing a few hints here and there, and I'm seeing some comments coming through from some companies talking about tariffs, but it doesn't seem to be material yet. Is this the last time that I can expect that to be true?
I think starting the third quarter, Guy, we are going to see both an impact on earnings that is gradually going to show, but also an impact on the real economy. So far, you could argue that both on the results of companies as well as on the data of the US economy and the global economy by and large, we have not seen so much effect of the tariff threat. But that is also very well explainable. One, there has been a tariff pause, so actually none of these really unraveling tariffs have come into effect. And then secondly, as a precaution, a lot of companies have built their inventories ahead of any tariff coming into effect. So once the first ones are likely to come into effect 1st of August, which is a very reasonable assumption to have, then we are also likely to see in the 2 quarters that follow first effects on both results of companies as well as the real economy.
But Nanette, you see 3 Fed rate cuts this year. If you don't see those effects showing up in earnings and the eco data until the 3rd quarter, is it really possible that we will get those rate cuts so soon? By the September meeting, for example, surely the Fed won't be able to settle this debate that's dividing the FOMC right now between whether inflation and the impact of tariffs is going to be transitory or persistent.
I think so. We are really quite comfortable with our assumption that there will be 2 cuts, certainly in 2025, most likely September and then later in the year. The reason is that, first of all, we should be seeing the negative impact on not so much of tariffs, but of the uncertainty about it on capex plans and then on the U.S. economy. We are only expecting half as much as what the U.S. economy is growing at potential. So our forecast for this year is about 1.2% growth in real terms in the U.S. That should give the Fed some room to cut interest rates, especially if those tariffs will act as they typically do when you have a VAT increase, a value-add tax increase. This is something that most economies are much more familiar with. And what it does is that it transitorily pushes up the price of certain goods that are affected. But then there are other price categories that are coming down because of the slower growth. Typically, this is the case for services inflation. And at the end of all these base effects moving out, long-term inflation expectations are remaining unchanged. So the Fed should be in a very good position to cut interest rates.
Finally, just a quick question. Energy prices. I'm really curious. This is one of the things that I've been reading about recently. What are the chances of a significant downdraft in energy prices? And how does that feed into the broader narrative that we're talking about here in terms of the inflation picture coming lower?
We have been, in fact, expecting that those energy prices would be lower than what they are now. And the reason that we've seen prices move up again from that path on which we were engaged really in the first half has been the trouble, the geopolitical trouble in the Middle East that had, in particular, an effect on trade of energy goods as well, or at least threat around it. And therefore, energy prices got, in our view, temporarily moved up again and away from that path lower. But for us, the probability is very good that we will see lower energy prices, number one, on higher supply of energy goods, in particular of oil, and number two, a slower economy.
It's interesting. It's going to be fascinating to see how that ultimately feeds into particularly the European economy. Nanette, thank you very much indeed. Nanette Hechler-Feder, EMEA CIO at Lombard Odier. Quick look at the call 6 to figure out what is happening there, and then we'll move on to the main event, which is the airline sector. As you can see, a fairly mixed picture this morning. No real standout stories that are worth focusing on there. There is a story in the auto sector this morning, and there's definitely a story in the airline sector. Let's find out what is going on. Chloe Medley standing by.
Good morning, Guy. Let's start with airlines this morning. So we got really good numbers from RyanAir. Its profit doubled in the fiscal first quarter. It really benefited from a recovery in fares, from strong travel demand, and also because there's an easing of the delays that were associated with aircraft deliveries. So that's really pushing up the stock 5% this morning, and also driving up EasyJet and Wizz Air, which are the other names in that kind of low-cost budget airline space. Moving on to a little bit of a less positive story in the auto sector this morning. So Stellantis recorded a 2.3 billion euro loss, and that was compared to expectations of a profit. A lot of that has to do with tariffs, and it's really dragging down the stock, but perhaps not as much as we thought it would this morning, down about 2%. It's a lot of these issues are company specific rather than a sector story. So it is dragging down a little bit of these other names in the car sector, but not that much. We've got Volkswagen and BMW down a little bit this morning, but Renault is quite resilient. Next up, we have got the mining sector. So iron ore is surging higher, and that is driving the stock in Rio Tinto and Glencore this morning, up about 2.3 and 2.8%. And then finally, we have got something in the real estate sector. So Covivio is in France. It's a real estate company, and it raised its profit forecast this morning. It's benefiting from a strong residential market in Germany. It also said that there was a stabilizing environment in the office sector, which is interesting, knowing the weakness that there has been recently in that market. So this forecast raise is pushing up the stock 2.4% this morning.
All right, Chloe, we thank you, Chloe Mallet, with our movers at the open. And we're going to dive into the RyanAir story even more next. Europe's biggest budget airline reporting a doubling of net income in the first quarter. We'll work out what's driving that very very strong booking for the holiday months next. This is Bloomberg.
We're seeing no softness in people who want to travel. We have limited growth this year. We're only growing by 3% to 206 million passengers. But demand is exceptionally high, and we've no qualms about hitting that target this year.
That's RyanAir CFO Neil Soranen speaking to us a little bit earlier. Europe's biggest low-cost carrier reporting a double of net income for the first quarter. It's getting the planes. It's getting more planes than it wants out of Boeing. Things are moving in the right direction. You can see what the stock reaction is this morning. Let's get Benedict Camel's take on this. He, of course, heads up our aerospace, aviation, defence, all of it, coverage, and talk about how this is having an impact this morning. Benny, let's talk about the stock move this morning. Big market reaction to the RyanAir numbers. It all looks pretty good. It does seem as if the airline is executing pretty well right now in a market that seems fairly favourable, with maybe people not taking the long-haul trips that they once did.
Yeah, you're absolutely right. I mean, generally speaking, when the market is a little tougher, when demand is tougher, that's where really the low-cost carriers come to the fore. People are taking shorter trips, both in terms of sort of time spent away and in terms of duration. RyanAir has a lot of these routes. The cost control is really doing well at RyanAir. We heard the CFO speak about it just now on TV a little while. So that's all really helping the company. And this is only the first quarter, so a lot of analyst reports that I've read this morning point to a very favourable outlook, saying there's real upside in terms of what they can do this year. So also an interesting contrast to some degree with EasyJet, who reported last week, and their quarter was, shall we say, sabotaged somewhat by the ATC strikes that we've seen across Europe, in particular France. RyanAir dodging that bullet a little better than it feels than EasyJet, so that's really helping the stock, up almost 10% today at an all-time high now.
And Benny, we had the CFO on Bloomberg TV earlier saying that any tariffs will be on Boeing's account, not ours. Just talk to me about how that tug of war works. For the non-airline expert in the room, is it as easy as saying we're not paying, they can?
Well, that's sort of the fight that we're in right now. And it feels as we move towards this August 1st deadline, nobody quite knows how it's going to play out. This is an industry that has lived in a tariff-free world for the better part of sort of 45, 48 years. And they now have to come to terms with who pays what, if anything. We've heard Airbus CEO Guillaume Faury say that we're not going to pay if we ship our planes to the US. We've heard Delta Airlines is a big customer for Airbus say, well, we're not going to pay. So really, you've got this bit of a stalemate. And RyanAir now saying the same thing, saying, well, we have fixed contracts with Boeing on our planes, on the cost, so we don't want to cough up that money. So how this will play out will be very interesting. These are mobile products, the aircraft, so they might find a way to sort of take them somewhere else first and then import them. But broadly speaking, this is uncharted territory for the industry, and we're hurtling towards that August 1st deadline. So the general view is everyone's saying we hope that sort of common sense will prevail, but again, you know, time's ticking.
Benny, just give me your take on the demand picture, though, that RyanAir is seeing at the moment, and how strong it is. There was this expectation maybe that we would start to see some of the demand fading. Where's it coming from? Why does it remain as strong as it has been, and why is the outlook so positive?
Well, they're doing very well in some, should we say, fringe markets. So they're flying into Scandinavia more, where the costs are low. They're basically able to move their kit around fairly nimbly, and they're going to places, as I said, Sweden is a big market, Eastern Europe is a big market. They're also benefiting from some of the weakness that others are experiencing. We know that Wizz Air has huge problems with their fleet, so that's helping them. Germany is not much of a bright spot for RyanAir, so that's probably one that is hurting them a bit, and it's been very difficult for them for a long time, but they can move into the places like Iberia, they can move into places like Spain, like Greece, Scandinavia. Those are their strong markets, and so it's a mix of people going to sort of lower cost airlines because they might reconsider the big expenses, and that some of the other carriers, in particular Wizz Air, is having a tough time.
All right, Benny, we thank you. Bloomberg's managing editor for global aerospace and defence coverage, Benedict Camel. Now, I want to stay in the transport space, but a more negative story for Stellantis. Shares moving lower after the automaker recorded a €2.3 billion net loss in the first half as restructuring expenses, waning sales and the impacts of US tariffs hit. So we can get more now with Bloomberg's Albertina Torsoli. Albertina, we talk about the tariff hit here. Is this actually a theme that we're going to see across automakers in Europe, or is this a more individual story unique to Stellantis?
I certainly think it's a two-way story here. The U.S. tariffs hit is quite something for the company. We still don't have full-year guidance for this company. It was given at the beginning of the year, then it was suspended because of tariff uncertainty. And today, as of today, we don't have guidance. And so what prompted Stellantis this morning, the maker of Fiat cars, but importantly of Jeep SUVs in the U.S., to issue this statement is this lack of guidance and the discrepancy between analyst forecasts and the reality that they are facing today. So they do cite a 300 million euro hit, about a 300 million hit from tariffs. That includes lost production as part of their response program. Stellantis had shut down some of the plants in the US while it had waited more guidance, more news on the tariffs. But there certainly are other items at play here. There are impairment figures. There is a closure of programs, and they will be giving more details on all that when they present full detailed first half results on the 29th of July. But some aspects are already emerging. For example, Stellantis decided quite recently, to drop investments in hydrogen. That has an impact today, and also is shifting a lot of the focus on hybrids. Former CEO Carlos Tavares was pushing all out on electric vehicles. The demand for electric vehicles is not there today as was expected, not in the US and not in Europe even. And so I think that there's a lot of readjusting of priorities here, and this is part of what we're seeing today beyond the general sluggish demand for automobile that we see everywhere in the US and Europe.
It's interesting, Albertina, we do have a new CEO in, as you say. Maybe part of what we're seeing this morning is a reaction, his first reaction maybe to what he's found under the hood, as Lizzy would call it, at the business. So it'll be interesting to see whether or not actually that's why we're seeing such a mild market reaction. Albertina, thank you very much indeed. Albertina Torsoli. Coming up, we're going to carry on our conversation about what is happening in Germany. German companies planning to invest 700 billion euros in the country's economy. We're going to have Allianz's CIO on next. Ludovic's going to be joining us in a moment. This is Bloomberg.
This is the opening trade, and we're 30 minutes into today's session. You're looking at the Stock 600, pretty flat at the moment. A bit of outperformance for the FTSE 100. That is the best performer across the continent, and the best performing sector is basic resources. So the two, of course, linked, the miners dominating the FTSE. You've got iron ore and steel prices climbing this morning on the back of China's plan for a mega dam in Tibet. That's bolstering the outlook for demand and boosting the likes of Glencore and Anglo-American here in London. But the trade story is going on in the background as we approach that August 1st tariff deadline, and the European Union is looking to send some of its envoys to meet to formulate a plan for measures to respond to a possible no-deal scenario with the US President Donald Trump. Now, the US is now seen to want a near universal tariff on EU goods, higher than 10%, but how is Brussels going to react? For more, we're joined by Bloomberg's trade czar, Brendan Murray. And Brendan, when you look at all of this, I wonder how likely retaliation from the EU is, what form that would take, and who it is out of the member state that's really pushing for the hardest kind of form of retaliation.
So these negotiations seem to be going along pretty well a couple of weeks ago, but something happened and they just sort of got bogged down on some of the key issues. We heard Commerce Secretary Lutnick over the weekend say that he thought he was confident that they could get a deal, but he also said, I think it's because the member states are going to realize that it's going to become more painful for them if they don't. So it wasn't like he was offering, because we're going to offer some concessions and we'll all see eye to eye in the middle. So the Europeans have a real big choice to make. Do they escalate? Do they meet Trump's tariffs with barriers of their own? Or do they sort of accept, an unfair negotiation and sort of take the economic pain? They have been saying all along they want that universal tariff rate to stay 10%. The U.S. is still at 30%, so can they get somewhere to, say, 20% without a lot of other member states saying that's too much for our auto industry or other industries that will be hit hard?
Back in April, the market freaked out. Everybody got really upset about what potentially was going to happen on the tariff front. We are now in the almost exact opposite scenario, where the market is unmoved by any of these headlines. Kind of, what is your assessment of the likelihood of something significant happening here? Or is the market right to park this one and kind of continue with this lack of sensitivity to these headlines that drop on an almost kind of minute-by-minute basis?
I think we've got a good enough track record now to say that the Trump administration strategy is maximum pressure, maximum leverage, apply that until the very end. We have 2 weeks until this August 1st deadline. And there seems to be, as you suggest, this complacency that eventually they'll see eye to eye and they're not going to go full transatlantic trade war. This is, after all, the world's biggest trade and investment relationship, and there's $1.5 trillion worth of economic activity between the two. Blowing that up would be detrimental to both sides. So I think there's a sense that they will get to some agreement. Someone's going to have to take the short end of that. And the Europeans are trying to figure out right now is what is that pain threshold that we'll be able to accept that the U.S. is going to apply.
We'll wait and we'll watch. And the next few days could be quite interesting. Brendan, thank you very much indeed. Brendan Murray updating us. It's going to be an interesting week this week. I think next week, really interesting. We're obviously watching all of this unfold as we think about how the German economy is kind of moving forward. More than 60 of Germany's leading companies unveiled in an investment drive worth at least 100 billion euros this morning. New projects we're talking about here. The whole idea is it's going to help lift Europe's biggest economy. Now, Bloomberg's Ollie Crook a little earlier spoke exclusively for two of the leaders of this group, Siemens and Deutsche Bank, the CEOs of both of those two businesses, and their aspirations and where they're going in terms of what they expect future growth to look like. They also talked about how the tariff story is going to impact the outlook as well.
Let's put it that way. We will end up in higher tariffs vis-a-vis the United States. Yeah. What we don't really want, actually we wanted to have lower ones because we believe in free trade. This stimulates economies and growth. So that would drive inflation to some point. However, there's one point which is super relevant is we have to stop this uncertainty. So once there's a deal, the deal should be the deal. And then we can deploy capital again based on facts, how the tariffs look like.
And we've been talking, Christian, a lot about European champions and changing the way that we think about preserving companies at the national level versus the European level. And I want to understand sort of when you look at Deutsche Bank, which is now at the end of what was a very long turnaround process, but now is feeling like it's in a strong and confident position. Is this a moment for Deutsche Bank to get into a much more sort of aggressive mode in terms of expansion mode, potentially looking at M&A across borders? What do you want Deutsche Bank's role to be in the kind of world of European champions?
Well, I do think what we see in this world is with all the geopolitical uncertainties, with all the also economic uncertainties, there is one trend which is the same across the world, that our clients want to have a European alternative to the US banks. Mm-hmm. We have very strong US banks, very capable US banks. But in this world of geopolitical uncertainties, they want to have a capable global European player. Mm-hmm. And there are not so many European banks left with a full investment bank, with a full corporate bank, with a global network in over 60 countries. That's the role we can play. Now, this role we not only want to play because we feel ourselves as a global bank, but it's obviously much easier to do that if you are coming from a country which is economically increasing, which is economically on the right path, and which is also pulling now Europe. And therefore, I think we have a unique chance, not only as Germany and Europe, but also as Deutsche Bank, to actually be the one who is facilitating and who is contributing to our clients' growth around the world. The diversification also in banking, not only to rely on one bank, but on many banks, and that from a regional perspective has never been bigger than now.
And you touched about diversifying, and just another question to you. Is this buy Europe trend, is this a lasting thing? Is this something that you're seeing from investors that you talk to, that they are wanting to make a meaningful commitment to Europe? And what does that actually look like in terms of numbers from where you're sitting?
Well, for the first time, we see, obviously, since the last 3 or 4 months, a quite significant reallocation from funds, in particular into Europe. The interest is huge. Whenever we talk with investors, they really want to understand what's going on in Germany, what's going on in Europe. By the way, already in Davos this year, 6 months ago, most of the investors said, micro, Germany is really good, and with that they mean the German corporates, the German companies. Macro, you need to do improvements.
You need to do improvements. Oh, we're going to start seeing those with the Merz government coming through. Certainly, the mood music coming from both of those two gentlemen really quite positive. Deutsche and Siemens, two of Germany's biggest companies. But in the background, we still have this huge threat that is coming in the form of potential tariffs. Ludovic Silbrand, Chief Economist and Chief Investment Officer at Allianz, joining us to discuss. In terms of where we are, Ludovic, right now, we've got this incredibly kind of positive picture being talked about by German corporates. We just heard from Deutsche, we just heard from Siemens. Yet we could be, there is the potential for significant tariffs to be imposed over the next few days. And the market is basically ignoring all of that. Where do you sit currently in terms of your expectations for how the European economy is going to develop, given the threat that it faces from this tariff war?
Well, look, it's a particular crossroads now, because we have a few weeks to know what's going to happen with the 30% tariff threat. We all hope for pragmatism and something landing around 10%. But of course, this is a huge uncertainty for all the corporates that are making, hundreds of billions of turnovers in the US, right? Just Germany alone, we're talking about 163 billion last year for German corporates in terms of revenue in the US. So imagine how much of a stake there is in this trade war to be muted in the next quarters. So it's a big topic. I think this Made for Germany initiative is extremely welcome. Germany is slowly but surely going over its PTSD from 2022, when it realized that the entire model was off. Yeah, and so I think this announcement is very important, alongside the announcement of public money that is going to be a key driver of growth for infrastructure, for defense, alongside reforms. But the key missing in action person, the one part that is very important, is the 99% of German companies that are SMEs and that need to grow their investment. Just to give you a figure, between 2019 and 2024, capex, investment by corporates in Germany went down 7%. So the government is also trying to do something about this, but it is also, there is part of psychology, as Ludwig Erhard used to say, the former Chancellor of Germany, but it is about, the moms and pop shops, the households, and this is where we still see record high savings, 20% plus, right? So there is still something there to unlock for Germany and for Europe in general, because this problem is widespread around Europe, to be also growing on its own without waiting for growth from outside, especially if uncertainty continues to be there when it comes to the trade war.
But which of these two factors will end up being more dominant, though? This idea that Germany does need to invest, this idea that there is the money there to unlock, and that can be deployed and can deliver significant results. But at the same time, the overarching theme is that we are facing a much tougher trade narrative with the United States, a key market for many of these small and mid-sized companies. Which of those two things do you think will end up being dominant? Is it possible to have a positive story when a trade war is looking more and more likely?
The answer is yes, because the domestic market in Europe is pretty huge. And this is, the Draghi report in action. We need to deepen our single market. We need to find ways for us to be independent on a series of topics, including energy, including tech, including the euro. So I think the trade war is a massive headwind. Let me start with that. I mean, a few percentage points of additional tariffs on Europe to the US is costing, a few, not 0.1, not 0.3, not 0.5 points of growth for Europe. So it's huge, right? And not to mention the ECB ECB. The ECB, we expect the ECB to pause this year, but if the tariff from the US is, landing around 15%, the ECB will have to drop another 50 basis points of key rate just to make sure that the financing of the economy is not endangered and that we don't go into recession, right? So there is really a Gordian node here, right near what here about the tariff, but there is also a lot of initiative that could be boosted here. Christian Zeving, the CEO of Deutsche, was talking about the reallocation into Europe. I talked to tons of CIOs from the US that tell me, money is following defense. Europe, yes, it's complicated, but it looks like you guys are after something when it comes to making your savings productive. So there is a correction of the negative bias that was, tainting Europe for quite some time. Also because we look more stable, we look more rules-driven. We also look a little bit more forward-looking in terms of where we want to spend the next 5 to 10 years of our massive efforts, be it with German public money being unleashed, but also the type of initiatives that are going on right now to make sure we are creating a form of different ecosystem, right? It doesn't save us from the thunder of what the trade war is going to bring, and beyond the trade war, also the frictions between the US and Europe on a series of topics, including on energy, including on defense, and including on finance. But it is a moment where it's quite interesting. I think the European Union, the European Commission are called for action by every business leader in Europe, which is also very interesting to see as a reverse call for action. We are really wanting them to make a bold move so that there is a form of trickle down of this whole Europe narrative, and it's not just a stint. Yeah.
Ludo, I was interested, you said that the ECB is going to pause rates this year. I take it that you don't see any more cuts for the rest of 2025. And when we think about the ECB, of course, it's not just trade as a channel through which Trump can affect the rates. It's also his threats to Chair Powell. We had the ECB's Joachim Nagel saying that the effects of ousting Powell would be felt outside the US. I wonder what you think that would look like for European markets and if you agree with him.
Yeah, so first, the ECB will pause this week, but we still have two rate cuts that are planned for September and October, just to get that right. So, but the real question is indeed what's happening on the euro dollar. It's been a massive roller coaster since the beginning of the year. And so there is now this moment we're a bit in a difficult situation now. We don't want the euro to be too strong, especially for our competitive advantage on trade, right? This being said, there is something here about building an alternative to the dollar as the dollar erodes slightly, that the euro becomes a currency where, emerging markets want to issue in, or a currency where a lot of the financing of the defense efforts we want to do have to be in this currency, just like, the energy sector needs to be in this currency to lower the dependency. So I agree. I would say whatever is happening now in the US and especially on the Fed is a massive driver of everything market related, including Europe. But there is also for us a bit of time to engineer something slightly different. When I think about the armada of stablecoins that are making their way to the markets right now, Europe needs to have a form of alternative to this. When I think about payment systems, we need to have an alternative for this. And I think President Lagarde called for action on this. I think a lot of us are thinking, okay, how is it a way for us to get some of the crumbs that the dollar is leaving behind and making it a strength at a moment where Europe is trying to turn around a bit the psyche of investors, of financial markets, and trying to make it, a homegrown market that is decent.
You talk about a call for action. Is that call for action going to be delivered outside of Germany? Germany seems like its own situation at the moment, and the rest of Europe doesn't. And I'm just wondering if the two fit together. The rest of Europe doesn't have the potential that Germany has right now, doesn't have a debt brake to release, the potential to spend all this money. Are we confusing Germany and Europe sometimes?
Well, there is, first, to be fair, it's true that when it looks like the heavy lifting for defense, everybody's looking at Germany because they are the only one with a fiscal space, right? So I often tell my French friends, if you expect that the German money going to defense is going to your big companies in France, you are wrong about this. We are one, but still, the German public has been saving for that moment. And so most of the externalities need to be for Germany. This being said, I think we see so many good news from Italy and Spain, who have basically been back on a primary surplus very fast, also because of the crisis they went through in 2012, 2014, but also because they've done the right reforms on a series of sectors and incentivizing a lot of private investment growth in the countries. In my country, France, we have a lot of big companies in the sectors that are in that's the moment of the sectors of defense. That's the moment of AI. That's the moment of energy transition. And it happens that a lot of these big companies and middle-sized companies are in France right now. So I would say the only way that this German moment becomes a European moment is if we look for complementarities and efficient specializations and comparative advantages, which is something Europe has not been historically very good at. We've all been very, standardizing a bit the expectations from countries. It looks this time around that some of the countries have something to offer. Not all of them have money to offer, that I would agree with you, but some of and my country, France especially, may not have a lot of money to offer, right, public money, but there is still, everywhere I look, there is still very high savings rate and there is still very low capex growth rate by companies. So that's where the psychological element is very important, because they both, households and companies, have some to unleash right now if we want to finance the next 5 to 10 years of Europe, including with a security tilt.
Well, yeah, we've got Merz and Macron meeting in Berlin this week. Both of them have been in London over the past couple of weeks. Maybe a sign of progress. But Ludovic Subran, Chief Economist and Chief Investment Officer over at Allianz, always good to have you and your beautiful art on the opening trade. We thank you. Coming up on the programme, we're bracing for a slew of earnings this week from sectors including banking, travel and telecoms. We'll get your preview next. This is Bloomberg. Minutes into today's session. Welcome back to the opening trade, and it's pretty much the stock 600 treading water this morning. The worst performing sector actually are the banks, and we already heard from the CEO of Deutsche Bank speaking to Bloomberg's Ollie Crook earlier in the programme. Speaking of which, we've got a slew of earnings in Europe this week. Banks, the big sector to watch. Lenders impacted, of course, by interest rate cuts and geopolitical tensions. So let's get a preview now with Bloomberg reporter Chloe Mellet. Chloe, let's talk about Deutsche. What are we expecting out of their results?
Yeah, so for Deutsche, we got a little bit of a preview, a taste of what's to come when the CEO recently mentioned that there had been a little bit of a bumpy second quarter in the trading business, and he kind of readjusted expectations down for the revenue there, and also mentioned a weaker than expected performance in the advisory business. So we know from that the earnings might disappoint a little bit. A bright spot might be the corporate banks. So obviously companies want to restructure their supply chains. They are looking to invest in defense industry as well, especially in Germany. So that might be a bit of a bright spot. We're also looking to hear about the progress on cost cuts there, the performance in the private bank, and there might be a buyback. Analysts are also thinking about that.
Is it the only bank reporting this week? I thought we got a few others.
We have a few others. So we have BNP, we also have NatWest and Lloyds. The key thing to look out for this earnings season, in particular as all those banks come through, is that the second quarter is likely to be much less resilient than the first quarter was. So things are starting to catch up with bank. Lizzy, you mentioned the interest rate cuts. That's starting to feed through into lower net interest income. We saw that with the Nordic banks earlier this earnings season, and obviously the tariffs and the uncertainty, that's feeding through into cost of risk and into maybe higher loan loss provisions as well. The UK banks might perform a little bit better. They have structural hedges, and that's kind of alleviating the impact of rate cuts and kind of shielding the revenue there. So that might be a little bit better from Lloyds and NatWest on Thursday and Friday.
Look forward to hearing all about it. Chloe, thank you very much indeed. Chloe Mellet joining us as we work our way towards some of those bank reports. What else are we going to be looking out for this week? The German Investment Alliance Summit is taking place today. We've already been hearing from the CEOs of Siemens and of Deutsche. We've got US home sales, I think, tomorrow. Merz and Macron are meeting in Berlin, as Lizzy was saying. We've also seen meetings with the UK leadership recently. How does it all fit together? Feels like a kind of three-way triangle beginning to be formed between Paris, London and Berlin. Thursday, global PMIs. Got EU and Chinese leaders meeting in Beijing as well. That's going to be fascinating. But maybe the main event on Thursday is going to be the ECB rate decision, though it is unlikely to deliver much of an outcome. I think the commentary going with it will be fascinating. Plus, also, we have UK retail sales out, which is usually something of a weather forecast or a retrospective weather forecast. Anyway, let's see what Valerie is going to have her eye on it this week. Joining us around the table, what are you going to be watching?
Well, I think European bank earnings are going to be interesting, as Chloe was talking about. But the other big highlight, at least for monetary policy, is going to be the ECB decision. And what's really changed between their June decision and now is you've had this renewed threat of tariffs, this 30% number talked about, threatened by President Donald Trump. And already at the June decision, Christine Lagarde characterized the risks to economic growth as tilted to the downsides. The market will be watching keenly on if she perhaps changes that language. Does she perhaps sound just an incremental a bit more bearish? Because if she does, I think the market will start to price in that the chance of a September rate cut. They do have a 7-week pause in between this decision on Thursday and September. So there's a lot, I guess, a lot of time in between those 2 points. Maybe we'll get more clarity on the trade policy, and with that, some more clarity on the rate trajectory for the ECB from here.
I also just want to talk about Japan, Val, because Guy told me don't even try and analyse the yen moves right now. Of course, you've got Japanese markets closed, the bond and stock market closed. But what do you make of what we're seeing of the limited reaction to that election result?
Well, look, the yen is stronger, so it's having a bit of relief. But also, look how European government bonds are performing this morning. I think they're anticipating we also see a relief rally when it comes to JGBs tomorrow when they reopen. So it does seem like a market-favorable election result. I think maybe the market was bracing for something a lot worse, or perhaps they had just priced in a lot worse in the weeks going into this decision. We know that, for instance, the yen had strengthened around 3%, weakened around 3%, and some JGB yields had hit 2-decade highs.
But do you think that that really is all about Japan? Or is it actually that the market's just looking through Japan and now looking onto the trade story and the ECB story?
Well, look, I think that Japan, it definitely has set the tone, at least for how fixed income has traded recently. So this could possibly just set us up for a decent, rally, a summer rally headed into July if those fiscal worries in Japan are put to bed for now, for whatever reason, whether that's warranted by this result from the election or not. But it seems to be the read-through so far this morning.
OK, well, we'll keep an eye tomorrow when we get Japanese markets back on after Marine Day. But Bloomberg's Valerie Teitel, we thank you for that setup to what's on the docket for the week. Of course, we've got a busy week for earnings here in Europe and that ECB meeting out of Frankfurt. A hold expected from Madame Lagarde. But as things stand, we're looking at the Stock 600 treading water, as I say, weaker 1/10%, slight outperformance from the FTSE 100, but things yet to pick up speed. Guy, you'll be with the next hour.
I shall. Yeah, we're going to carry on the conversation, figure out exactly what is happening in the bond market, try and analyse what is going on in Japan, and prepare ourselves for what is going to happen on the trade front next. That seems to be the narrative we're building to this week and into next. We'll leave you with the grey skies of London, a few blue moments peeking through. This is Bloomberg.